September 23rd, 2013, the Federal Reserve launched what they called a technical exercise. Just another boring monetary policy test, they said. A temporary tool to help control interest rates when the time came to end quantitative easing. The first day, this new facility absorbed exactly $11.81 billion. The Fed called it temporary. They called it supplementary. They called it a safety valve that would only be used when absolutely necessary, then quietly phased out when our financial system returned to normal. Fast forward 12 years. That same facility now holds over $2 trillion every single night. That's more than the entire GDP of Canada, parked at the Federal Reserve, earning interest, going nowhere. What was designed as an exit ramp became a parking lot. What was supposed to be temporary became the foundation of our entire monetary system. The Fed built a money trap so effective, so attractive, so seemingly safe that trillions of our dollars can't escape. And here's the thing that should terrify every American investor, homeowner, and worker. Nobody saw this coming. Not the Fed governors who created it, not the Wall Street executives who now depend on it, not the politicians who pretend to understand it. This is how the most powerful central bank in human history accidentally broke the American financial system with a tool designed to fix it. Let me take you back to 2013, when our financial leaders thought they had everything figured out. The financial crisis was behind us. Quantitative easing had saved the day. The Fed's balance sheet had exploded from less than $1 trillion to over $4 trillion, flooding our banking system with unprecedented amounts of cash reserves. Everything seemed under control, but there was a problem brewing beneath the surface. A technical problem that would require a technical solution. When you flood a financial system with that much money, strange things start happening to interest rates. Our traditional tools for controlling short-term rates were breaking down. Here's what was happening. Before 2008, the Fed controlled overnight interest rates by buying and selling small amounts of government bonds. Simple, elegant, effective. But after pumping trillions into the system through quantitative easing, there were so many excess reserves floating around that overnight rates were falling below the Fed's target. Banks had so much cash they were practically paying each other to take it. Think about it this way. Imagine you're trying to control the water level in a bathtub by adjusting the faucet. That worked fine when the tub was nearly empty. But now the tub is overflowing, water everywhere, and your little faucet adjustments aren't doing anything. You need a drain. So, the Fed created a drain. They called it the Overnight Reverse Repo Facility, or RRP for short. The mechanics were brilliantly simple. Money market funds, banks, and other financial institutions could park their excess cash with the Federal Reserve overnight. In return, the Fed would give them treasury bonds as collateral and pay them a small amount of interest. The next morning, the whole transaction would reverse. Cash back to the institutions, bonds back to the Fed. For these institutions, it was the perfect deal. Risk-free returns backed by the full faith and credit of the United States government. No counterparty risk, no credit risk, no market risk. Just park your money with the most powerful central bank in the world and collect interest while you sleep. The Fed initially limited who could use this facility. Only primary dealers, the elite banks that trade directly with the Federal Reserve. But as the system evolved, they expanded access to money market funds, government-sponsored enterprises, and eventually a broader range of institutions. The whole thing was designed as a safety valve. When the Fed finally decided to end quantitative easing and shrink their massive balance sheet back to normal levels, this facility would help control interest rates during the transition. It would absorb excess liquidity when needed, then quietly disappear once the financial system returned to its pre-crisis state. Federal Reserve officials spoke confidently about this tool's temporary nature. It was a bridge to normalization, they said, a technical mechanism to smooth the transition back to normal monetary policy. Usage would fluctuate based on market conditions, probably staying in the hundreds of billions at most. Once their balance sheet normalized and excess reserves drained from the system, the facility would become largely unnecessary. Nobody at the Fed predicted what would happen next. Nobody anticipated that this temporary safety valve would become permanent. Infrastructure. Nobody imagined that, within a decade, this modest technical tool would be absorbing more money than flows through most countries' entire economies. The first sign something was different came during times of market stress. When financial institutions got nervous, when markets got volatile, money would flood into the reverse repo facility like a river rushing toward the sea. The Fed had created something unprecedented in financial history, a perfectly safe harbor in every storm. But storms weren't the only thing driving money into this facility. As we'll see, the very structure of our post-crisis financial system was pushing more and more cash toward the Federal Reserve. Money market funds, constrained by regulations designed to prevent another 2008-style crisis, found fewer and fewer places to safely park their clients' cash. Meanwhile, the Fed kept expanding who could access this facility, kept raising the interest rate they paid, kept making it more attractive relative to other short-term investments. What started as a small technical adjustment became the gravitational center of American finance. By 2013's end, the facility was absorbing tens of billions regularly. By 2014, hundreds of billions. The Fed kept calling it temporary, kept talking about normalization, kept planning for the day they could phase it out. But the money kept coming and coming and coming. The trap was set. Not intentionally, not maliciously, but perfectly nonetheless. The Federal Reserve had created a tool so effective at absorbing money, so attractive to institutions managing trillions in assets, so superior to every alternative that it would soon become indispensable to the functioning of American capitalism. The safety valve was about to become the system itself. March 2020. The world stopped, markets crashed, panic spread faster than the virus itself. And the Federal Reserve did what central banks do in a crisis. They opened the money spigots wider than ever before in American history. Unlimited quantitative easing, they announced. Whatever it takes. The Fed's balance sheet exploded from $4 trillion to $9 trillion in a matter of months. They printed more money in 2020 than in the previous decade combined. Cash flooded the financial system like a broken dam, drowning banks, money market funds, and financial institutions in more liquidity than they knew what to do with. Here's where our story takes a dramatic turn. Remember that modest reverse repo facility, quietly absorbing tens of billions here and there? Suddenly, it wasn't modest anymore. By early 2021, the facility was still relatively small, holding close to zero most nights. Money market funds were finding places to park their cash. Treasury yields were low, but positive. The system seemed to be absorbing all that Fed liquidity just fine. Then something changed. Treasury yields didn't just fall, they crashed through the floor. 3-month Treasury bills, supposedly the safest investment in the world, started yielding less than the cost of operating a money market fund. Some short-term rates even went negative in real terms when you factored in inflation. Picture this scenario. You're managing a money market fund. Your clients expect their cash to be safe and earn at least some return. But suddenly, the safest investments in America are paying you less than it costs to manage the fund. You're literally losing money by investing safely. What do? You park everything at the Fed's reverse repo facility. Because while Treasury bills might pay you 0.05%, the Fed was offering 0.05% with zero risk, zero hassle, and zero chance of loss. Same return, but with the explicit backing of the central bank itself. This is when the facility exploded, not gradually, not quietly, but like a financial volcano. Usage went from near zero in early 2021 to over $2 trillion by mid-2023. Money market funds from BlackRock, Vanguard, Fidelity, the giants managing Americans' retirement savings, emergency funds, and corporate cash, all started parking massive amounts at the Federal Reserve every single night. The numbers were staggering. On peak days, the facility held $2.3 trillion. To put that in perspective, that's roughly equivalent to the entire annual economic output of Canada, just sitting idle at the Federal Reserve, earning interest, going nowhere. But here's what made this explosion particularly insidious. It created a feedback loop that kept strengthening itself. The more money parked at the Fed, the less liquidity circulated through our real economy. Banks tightened lending standards because they had less access to short-term funding. Small businesses found credit harder to get. Meanwhile, more institutional cash sought safety, driving even more money toward the Fed's facility. As inflation surged in 2021 and 2022, the Federal Reserve started raising the interest rate they paid on the reverse repo facility from 0.05% to 5.3% by 2023. Suddenly, parking cash at the Fed wasn't just safe, it was profitable. More profitable than lending to most businesses, safer than most corporate bonds, more reliable than most bank deposits. Think about the absurdity of this situation. The Federal Reserve, created to promote lending and economic growth, was now paying higher interest rates than most private borrowers could afford. Money market funds could earn 5% risk-free by parking cash with the government, while small businesses were struggling to find loans at reasonable rates. The unintended consequences were staggering. By 2023, the Fed was paying over $100 billion annually in interest to money market funds. That's taxpayer money because the Fed's profits normally flow to the Treasury. Instead of the Fed contributing to government revenues, American taxpayers were essentially subsidizing Wall Street's demand for perfect safety. Meanwhile, our real economy was starving for credit. Small businesses couldn't compete with the Federal Reserve for access to capital. Community banks found their deposit bases drying up as money flowed toward higher-yielding money market funds that immediately parked everything with the Federal Reserve. The very institutions that were supposed to finance American growth and innovation were being crowded out by our own central bank. But the damage went deeper. The Fed was now competing directly with the Treasury for the same pool of investors. When $2 trillion sits parked at the Federal Reserve earning 5%, that's $2 trillion not available to buy Treasury bonds at government auctions. The twisted irony was complete. One arm of the government was making it harder for another arm of the same government to finance its operations. Treasury auctions started showing signs of strain. Weaker demand, higher borrowing costs for the government, more volatile pricing. The Federal Reserve had accidentally created a competitor to its own government's debt issuance. Both the Fed and Treasury were fishing in the same pond, driving up the cost of government borrowing while simultaneously paying out billions in interest to the same investors. There had been warning signs. In September 2019, the overnight repo market had seized up spectacularly. Rates that should have been around 2% spiked to 10% in a single day. The cause? Too much cash locked up in bank reserves, too little available for the daily settlement of Treasury transactions. The Fed had to inject hundreds of billions of dollars instantly to prevent a complete breakdown of short-term funding markets. That crisis should have been a wake-up call. It showed how fragile our financial plumbing had become when too much money gets trapped in reserves instead of circulating freely. But instead of addressing the underlying structural problem, the Fed just added more tools, expanded the reverse repo facility further, and kept building the very trap that was causing the instability. By 2023, the facility had become something the Fed never intended, a permanent parking lot for American capital. Money market funds had lost the ability and incentive to lend to banks, corporations, or anyone else. Why take any risk when the Federal Reserve offered perfect safety at competitive rates? The regional bank failures of 2023, Silicon Valley Bank, Signature Bank, First Republic, only made things worse. These collapses reminded everyone why counterparty risk matters, why even banks can fail, why the Federal Reserve's reverse repo facility was the only truly safe harbor in any storm. Money market funds that might have considered alternatives doubled down on their Fed deposits. What started as an $11.8 billion technical exercise in September 2013 had become a $2 trillion permanent fixture of American finance by 2023. The Federal Reserve had created a mechanism so safe, so attractive, so perfectly designed to absorb money that trillions of dollars would rather sit idle earning 5% than circulate through our economy, building businesses, creating jobs, or financing innovation. Every night, the money flows in. Every morning, it stays put. The facility was designed to be temporary, a bridge to monetary normalization. Instead, it became the new normal, $2 trillion frozen solid, not lending, not investing, not building the future, just parking. The Fed built a trap so perfect that even the Fed couldn't escape it without risking the collapse of the very system they were trying to protect. By 2024, Federal Reserve officials were starting to get nervous. $2 trillion sitting idle every night wasn't what they had in mind when they created their temporary safety valve. They wanted that money circulating through our economy, financing growth, supporting businesses, creating jobs. The facility was supposed to be an exit ramp from crisis policies, not a permanent parking garage for American capital. So they tried to encourage an exit. They started talking publicly about their desire to see usage decline. They hinted that institutions should look for alternatives. They even began subtle policy adjustments to make other short-term investments more attractive relative to their facility. But here's the problem with building a perfect trap. Even the trap's creator can't force anyone to leave without risking everything. The Fed discovered they couldn't simply shut down the facility or make it less attractive without potentially triggering the very crisis they were trying to prevent. If money market funds were forced to exit too quickly, short-term interest rates could crash below the Fed's target, undermining their entire monetary policy framework. If the exit happened too slowly, the Treasury would continue struggling to find buyers for government bonds, threatening the government's ability to finance its operations. There was no smooth exit path. Every option led to instability. Early 2024 gave us a preview of this fragility. Something interesting happened. Treasury flooding the market with new Treasury bills at higher yields than the reverse repo facility was offering. For the first time in years, money market funds had a genuinely attractive alternative to parking cash at the Fed. The response was dramatic. Reverse repo usage plummeted from $2.3 trillion to around $700 billion in just a few months. $600 billion shifted from the Fed to Treasury bills almost overnight. You might think this was exactly what the Fed wanted. Mission accomplished, money flowing back into productive uses. Instead, it triggered exactly the kind of instability that proved how fragile our financial system had become. Short-term funding rates started swinging wildly. Mortgage rates became more volatile because they depend on stable short-term funding markets. Corporate borrowing costs fluctuated unpredictably. The system had become hypersensitive to any change in this massive pool of money. Think about what this means for your daily life. When $600 billion shifts from one government facility to another, your mortgage rate moves, your credit card rate adjusts, your employer's ability to get working capital changes, the availability of auto loans fluctuates, your 401k performance gets affected, because pension funds rely on these same short-term funding markets. We built a financial system where the decisions of a few dozen money market fund managers about where to park cash can ripple through every corner of the American economy. When BlackRock's money market fund decides whether to park $50 billion at the Fed or buy Treasury bills, grocery store chains feel the impact through their supply chain financing costs. But the instability goes far beyond our borders. Foreign central banks and sovereign wealth funds use U.S. repo markets to manage their dollar reserves. When liquidity shifts dramatically in American short-term funding markets, it sends shockwaves through global currency markets. The late 2023 decline in reverse repo usage coincided with significant pressure on the Japanese yen and Chinese yuan. Capital flight, currency volatility, and emerging market stress, all triggered by changes in Fed facility usage. This is what happens when the global financial system runs on dollar liquidity, and that liquidity gets trapped in a single central bank facility. Every shift affects everyone, everywhere. Perhaps most troubling is the psychological trap this system has created. Financial institutions have lost the ability to assess risk independently. Why bother analyzing whether to lend to a corporation, a bank, or a government when you can just park everything with the Federal Reserve and earn guaranteed returns? The facility has created a massive moral hazard problem throughout our financial system. Risk-taking disappears, innovation slows, economic dynamism dies. When the safest, most liquid, highest quality borrower in the world, the Federal Reserve, is competing directly with private borrowers for the same pool of funds, private borrowers lose. Every time. Small businesses can't compete with the Fed's credit quality. Startups can't offer the same safety as government bonds. Community development projects can't match. The liquidity of overnight deposits with the central bank. The reverse repo facility doesn't just absorb money. It absorbs the economy's capacity for productive risk-taking. But here's where this story gets truly frightening for anyone who values financial freedom. The reverse repo facility is serving as a training ground for something much bigger. central bank digital currencies. Think about what the Fed has proven with this facility. They can manage massive flows of digital money with perfect precision. They can turn liquidity on and off like a light switch. They can track every dollar, monitor every transaction, control every flow of funds through the financial system. When central bank digital currencies arrive, and they will, the same mechanisms that power the reverse repo facility will expand to cover every dollar in your wallet, every transaction in your bank account, every purchase you make. Programmable money with built-in spending restrictions, expiration dates, and complete government oversight. The reverse repo facility is proof of concept for total monetary control. Every night, $2 trillion flows into a system where the Federal Reserve decides who gets access, at what rate, under what conditions. It's a prototype for a world where every dollar is managed the same way. Meanwhile, the trap keeps strengthening itself. The Fed can't unwind the facility without risking a 2019-style repo crisis, but 10 times larger. Keeping it perpetuates the liquidity freeze that's starving our real economy. Either choice creates instability that could trigger broader financial chaos. The Fed is trapped between maintaining a facility that freezes trillions of dollars in unproductive uses, or shutting it down and potentially causing the kind of market disruption that could crash the global economy. There's no good option because the system has become dependent on this mechanism that was never supposed to exist. This follows a depressingly familiar pattern in Federal Reserve history. Every temporary tool becomes permanent infrastructure. Quantitative easing was temporary. 15 years later, they still hold trillions in bonds. Interest payments on bank reserves were temporary. Now they're structural features of monetary policy. The reverse repo facility was temporary. Now it's a $2 trillion fixture that can't be removed without threatening system stability. Emergency measures become permanent institutions. Crisis tools become normal operations. Temporary facilities become the architecture of American finance. Today, as you read this, over $2 trillion sits frozen at the Federal Reserve. That's money that could be building factories, funding research, supporting small businesses, or financing the next great American innovation. Instead, it earns 5% annually while contributing nothing to economic growth. Money market funds can't leave because nothing safer exists in our current system. The Federal Reserve can't close the facility because doing so would trigger massive instability. The Treasury can't compete with it because the Fed offers better terms with better collateral. Small businesses can't access capital because institutional money prefers the certainty of government backing. You can't escape its effects either. Your mortgage rates, credit costs, and job opportunities are all influenced by this massive pool of idle capital. When $2 trillion sits frozen instead of circulating, everyone feels the impact through higher borrowing costs, tighter credit, and reduced economic opportunity. This isn't a crisis in the traditional sense. There are no bank runs, no market crashes, no screaming headlines. This is something more insidious, a design flaw that became permanent infrastructure, a safety mechanism that transformed into a systemic risk, a temporary tool that became the foundation of modern American finance. The Federal Reserve built a mechanism so effective at absorbing money that it can't release those funds without potentially breaking the system it was designed to protect. Every dollar parked at the Fed overnight is a dollar not circulating through our economy, not financing productive activities, not building the future. The trap was supposed to be temporary. Instead, it became the defining characteristic of how our monetary system works. The safety valve became the system. The $2 trillion sitting frozen every night isn't a feature of healthy financial markets. It's proof that our financial system no longer works without constant Federal Reserve intervention. This is how central banking broke in America. Not with a dramatic crisis, but with a tool designed to prevent one. Not with malicious intent, but with a safety mechanism that worked too well. The Federal Reserve created a perfect solution to a temporary problem, and in doing so, made both the solution and the problem permanent. Nobody can escape this trap, not Wall Street, not the government, not the Fed itself, without risking the collapse of the very system that trap was built to protect. And that, more than any crisis, more than any crash, more than any traditional financial disaster, should terrify every American who thought our monetary system was designed to serve the productive economy rather than simply manage its own contradictions.